Right, big old question this one, folks, so let's get on with it. It says, this is what we're going to do, part A. Perform some preliminary analytical procedures, evaluate the audit risks, which is the whole reason for doing analytical procedures, for planning the audit. Also, identify any additional information that we'll need. So we've got to do some analytical procedures. From that, get some audit risks, and then put in any extra information we need. So let's go to the scenario then. It's a new audit client. Well, that's already an audit risk, isn't it? Okay, so we could talk about that in a little bit. We're planning it, and you've just attended a meeting. She gave you the projected results, and they are a health and beauty products company. Okay, so then they give us some information there, some income statement information, some balance sheet information, some notes, and that's it. So obviously giving us that information to do some analytical procedures. Okay, so that is what we have to do. So let's get on with doing it then. So in terms of analytical procedures, we've got to think of profitability. Got to think of liquidity. Got to think of solvency or gearing. Okay, they're the main three that you'll have to worry about. So, in terms of profitability, then I'm not going to do the analytical procedures for you. You can do that in your own time, but let's just have a look at a general picture. So we can see that revenue has decreased from 8,500 down to 7,800, and you'd say, oh, that's a fall of about 8.2%. You would also look at gross profit. That's fallen from 2,700. Looks like it's going to fall to 2,120, so a fall of about 21%. Operating profit, that's fallen, a fall of about 33%. And all of these figures I would put in an appendix to begin with. So you'd put them in an appendix. What else would you do? You would do some margins, wouldn't you? So you'd say, instead of just trends, margins. So margins is divisible by sales. So 2,120 divided by 7,800. So have a look at what's happened to the gross profit margins. And the gross profit margin has gone from 32%. This is the margin. It's gone from 32 to about 27. Operating profit margin, so operating profit as a percentage of sales, that's also gone down from 15.6% to about 11.4, I think. Okay, as I say, you can do those figures yourselves, and that's how I would start it off. So I'd do that in an appendix, and then I'd just put it here. I'd put revenue fall, gross profit fall, operating profit fall, put the percentages in, talk about the margins of the gross profit and the operating profit, how they've fallen, put the percentages in, and now I've got to talk about why I think it's happened and what effect it's going to have on my audit. So where are my audit risks? So if I go back up to these percentages, we can see that gross profit has fallen. Now, for gross profit to have fallen, it's got to be something to do with either the selling price or the cost of sales. And operating profit as well, it's fallen by a bit more. So something in operating expenses is probably a little bit strange going on there. So I need to find out why, really. So have a look. It says note 1. So here we go. Note 1. Cost of sales includes 250,000 relating to a provision. The Advertising Regulatory Authority has issued us a 450,000 fine due to inappropriate claims made by an advertising campaign. This fine is being disputed and the matter should be resolved in August 13. So we've got this potential provision of 450. Now the first thing that I notice is I've only put in 250, so that's an extra 200,000 extra cost that could possibly be happening. So I'd also put in here extra potential expense due to the provision. And I'll talk about the provision in a bit more detail afterwards, I think. And that's all I could do at the moment for that bit, but I still want to keep going through the questions. I want to find out why my gross profit margin has gone down. So let's have a look. Business review. We're facing difficult trading conditions. Right. That helps me a bit. So revenue has gone down because difficult trading conditions. And remember, this isn't a normal ratio analysis question. This is an audit question. You've got to think about what effect this has on my audit. Consumer spending is depressed due to recession in the economy. The health and beauty market remains very competitive, and there's a major competitor who's launched a very successful new product range during the year, which led to a significant decline in one of our most successful brands. So, competition. It has been necessary to cut prices. There you go. That explains my profit margin. Cut prices due to competition. All of these would be one sentence things in an attempt to maintain market share. However, we do have a new brand using organic ingredients that's being developed and will launch in September 2013. So in terms of profitability, remember one of the information is what new information do I need? One of the questions is what new information? Well, I'd want, has there been any market research, any forecasts on the new product? So having a look at this, I think the main issue here, everything is falling. We have big competition. I'm hoping that you'd realise the auditing concern is definitely a going concern issue. Okay, so we definitely have a going concern issue, particularly if the new range fails and maybe we start ending up being a loss-making company. Okay, so I'm on alert for going concern issues with the audit. So far so good then. I go on to liquidity. Liquidity is always your current assets and your current liabilities. So we've got, first issue is the cash by the looks of it. I did have $1 million in cash, now I've got 0, but let's have a look at my current liabilities. Have I got an overdraft? Yes, I have. So the first thing about liquidity is I look at the cash, don't I? So I've gone from 1 million cash to 0.9 million overdraft, which is a huge fall. Then I would have a look at my current assets compared to current liabilities. So current assets compared to current liabilities. So 3965 compared to 2185. Work out what that was. Compared to 3,500 compared to 3650. So the big point is here, my current liabilities are bigger than my current assets. So I would work out what I've just done there. I'd work out the current ratios. Okay, put those numbers in my appendix and I'll say the current ratios are getting worse, but particularly my projected figures are the current liabilities are bigger than my current assets, which means I really do have a going concern issue here to worry about. What more information would I definitely want now? Okay, I want to know my cash flow, because cash is going away, isn't it? I've only got 0.9 million. I've got more liabilities to pay. I want a cash flow statement. I want a cash flow forecast to see if I can pay these things. I would carry on though, because the other things that I want to be doing is in liquidity. I want to be doing inventory days, which is your inventory divided by your cost of sales times by 365. Trade receivables is your receivables divided by your sales times by 365. Your payable days, which would be your payables divided by cost of sales times by 365. I would do all of those and I will just give you some figures. Payables went from 63 days to 86, and I would say, what does that show? It shows that I can't pay them. I'm taking longer to pay, and if I can't pay them, what's going to happen? They may stop supplying me. Not only may they stop supplying me, they may at least reduce my credit terms, which will mean I will struggle with cash, okay? So I clearly have these cash problems. My receivable days have gone from 34 to 42, so they're getting worse. So I've got poor credit control, possible bad debts, and if I've got bad debts, then I'd say, look, do I need a bad debt provision now? Have I included that? If I have, that's going to make my profits even worse. My inventory days, they've gone from 136, which is huge anyway, to 167. 167 days in stock, so definitely obsolete stock I would be worried about. That's my audit risk, that I've overstated stock. So that's where I go and focus my activity, definitely on bad debt provisions, definitely on overstated stock. Do I need a write-off? If I do, it's going to make everything worse, isn't it? So real going concern issues here just through looking at the liquidity. So then I would go on to solvency, which is my gearing. So you go and have a look at your balance sheet with your gearing, which is your total amount of equity compared to your debt, okay? And you can see that it's they're half and half there, so it's highly geared compared to before when we had less debt, so it is highly geared. So we have high gearing, and that high gearing is getting worse. Also remember, we've got the overdraft now. In terms of more information then about the overdraft, I want to know things like what's the limit of the overdraft? Any covenants on the overdraft? When are my loan repayments? When does that loan have to be repaid that I've got in there? I think I saw a loan anyway. Yeah, bank loan, which is increasing rapidly, so I put that in there. Finance leases, I probably want to know when I got those. I want to have a look at the finance lease agreements. Okay, so plenty of things there. Now the big problem with gearing is always your interest cover. So you go to your interest cover, which is on your income statement. So literally, how much is my operating profit covering my interest costs? Okay, I think it's getting slightly worse, or well, it's getting a lot worse, but it's still covering it quite a few times. I think that's about 5.7 times, which is still okay. So interest cover, I would say, seems okay, but the only problem is do I have the cash to pay it? I may have the profits, but do I have the cash to pay it? All right, so I've gone through all of those figures I would have put in the appendix. I would have just written sentences about it. And then I'm just going to carry on now. So I'm going to start right back up here. And I think, right, I've looked at the revenue, I've looked at cost of sales, I've looked at operating expenses. Finance costs, 155. We said that's okay. And it's a little bit strange that that's okay. Only 155 when we've got, you know, long-term debt of 11,825. So it's a very, very small finance cost. So that might be something I want to have a look at. Very small finance cost. Probably want to have a look at what it's made up of. Why does that seem such a small amount? If we've got big loans, I would imagine we'd have a big interest charge, but we don't seem to have. Taxation, again, taxation going down, which seems a bit strange. It's a profitable company, and it's gone from, you know, profit before tax of 1197 to 735. So I guess we would expect it to go down, but it only looks like about 10% tax, which seems a little bit cheap. So I would probably want to know about tax. I'd say seems low. I want to have a look at the tax computation. Okay, so a full sentence for all of these, because the whole point is you look at the accounts and you think, look, what looks odd? What looks like there might be something wrong? Okay, so on to the balance sheet. My PPE has increased. My PPE has increased, and that's either because I've bought some or I've had a revaluation. and I've had a revaluation. Okay, so if I've had a revaluation, I'm always worried about a couple of things. So I've had a revaluation of 500. First of all, the accounting treatment. I want to make sure that it's been accounted for correctly, which means the gain should have gone to the OCI. And there's no mention of an OCI, so where have they put that gain? Have they put that to the income statement? If they have, that needs to be dragged out and it's looking bad again. When I have a revaluation, there's normally some deferred tax. Okay, so again, my tax charge seems low, and it should include some deferred tax. Let's just go have a look at deferred tax on our balance sheet. And I don't, I just have current tax. And even that current tax is low, isn't it? So current tax is only 50, and I think my tax for the year was 70. So why is that different as well? So tax, I want to see the computation. I want to know why 50 only payable when it says 70 on the income statement. Why no deferred tax element when I'm doing a revaluation? And the other thing, so none there. The other thing that I'd be worried about is depreciation. Has depreciation been calculated on the new amount? Okay, because sometimes it's not. And possibly have a look at the disclosures as well. So loads of things that I'm picking up on about where I should go in my audit. But I'm just going to keep on going down. Development costs, always an issue, isn't it? Let's go and have a look at note 2, it tells me. Note 2, development costs relate to a new range of the organic cosmetics. Alright, so development costs. The issue here is, should they be capitalised? As always, does it include anything that really should be expensed? Okay, sector is what I use. The sector criteria, you might use pirates. Okay, but as long as you know what they are, I don't know if you even have to write them out, just say that there's certain criteria. Have the criteria been met or not? You know, don't even really have to write them out. Because if not, then there's possibly some more expense missing, and therefore overstating of assets as well. Overstating assets and profit. And I want to, therefore, more information is that I need a breakdown of these costs. Keep going. Where did I get to? Yeah, inventory I've dealt with, trade receivables I've dealt with, cash I've dealt with, shares, nothing's happened with that, revaluation reserve I've dealt with, retained earnings, well that's just my income statement which I've dealt with. Preference shares, 2% preference shares. The issue with a preference share, they put it to debt, so therefore the preference shares dividend should go to interest. And remember, our interest charge is really low. So preference shares, I just want to make sure the dividend should have gone to finance costs. I hope they've put it there and not as a deduction to retained earnings, which is where you put normal dividends. Okay, particularly as the finance costs are low in the accounts, lower than 2%. So it does seem a little bit odd, something strange going on there. Bank loan. Yeah, I've mentioned about when does this have to be repaid. I definitely want to see that. I've mentioned that we want to see some finance leases, see when they were taken out, make sure that the interest on the finance leases is accounted for correctly. So finance lease, has the interest been accounted for correctly? Because again, my interest charge is so low. Keep going. Provisions, we talked about that, so the provision, I'll talk about it in a little bit more detail here. You say forward provision, it needs to be, you need to have a reliable measure, it needs to have an obligation, it needs to be probable, and according to note 1, all of these have been passed, and so therefore we should have a 450,000 provision, not 250. So therefore we've got this extra expense, and so again I think that we here have understated liabilities and overstated profits again. So with all this overstating of profits, I'm really worried that the profit is going to turn itself eventually into a loss, which would be a huge going concern issue for me. Keep going down then, the overdraft we've talked about. We'd like to know the interest charge on that. And then let's keep going there. So note 3 says, he mentions that it was revalued by an independent, professionally qualified expert. So the revaluation would be a little bit worried that they're trying to overstate their assets. So there is a possible overstatement issue. Maybe they need it due to bank covenants or something. We're not saying they have, we're just saying it's possible. You know, we're being professionally sceptical, so we'd like to see the experts' qualifications and report. Make a point about all of these folks. Financial matters, cash flow has been a problem this year due to the cash spent on developing the new product range. Cash was also needed to pay dividends. To help reduce cash outflows, some new assets were acquired under finance lease, and an extension to the bank loan was negotiated. Well, I think we've mentioned all of those, the need for cash flows, the need to see the finance lease. We came up with that anyway. Human resources. In December 12, Parker's internal audit team performed a review of the controls over overtime. The review found that the company's internal control procedures to overtime and tax were not always being followed. So immediately we've got an audit risk there. So payroll, control risk is definitely high. We want to know how significant is this. Okay, do we have any monetary values that we can put on this? Is it likely to reoccur? Okay, until December, this processing was split between human resources and finance. Since then, it's all been carried out by the finance department. All been carried out by the finance department. So now there's no segregation of duties, which makes the risk even higher. So we'd want to go and have a look at payroll in a bit more detail, do some more testing on that. Finally then, expansion plans. Management is planning to expand the operations into beauty salons. It's a growing market, there's a synergy where their goods can be sold. Expansion would be through the acquisition of an existing company. Okay, so this potential target, well, if we're going to do this, we're going to need cash. Where are they going to get the cash for expansion from? Because debt will be tricky, because we're already highly geared, and we've already extended our current bank loan, and we've also got an overdraft now. So the question would be, where would the money from the expansion come from? And therefore, if no expansion, what's the plan? Discuss that with management, because we are really concerned now about going concern. And I think that would do, really. Finally, we've got the new client issue we didn't mention. When you've got a new client, you've got more risk due to lack of knowledge of the business. Okay, so I think I would probably mention that, so more detection risk. But also we'd have to do more work and be careful on comparatives and opening balances, making sure they're correct, making sure that the accounting policies are appropriate. All general things that you do with a new client. I wouldn't go into too much detail on it though, because the scenario didn't, did it? So we're always governed by the scenario. So what I want you to take away from that is how we approached it. We used the analytical procedures in order to point us as to where to go. We used every single number they gave us, and we used every single piece of information they gave us. And as we was using that information, including ratios, what we were doing was saying, right, this is why it's important, and this is how it affects my audit risk all the time. But I went through the whole thing, and if you do that, so if you do the ratios, talk about why, talk about effect on risk. Make sure you put the ratios in the appendix. And if you use all the numbers and use all the words, you cannot help but score really well on a question like that.